I love that AI can do so much in our lives and be incredible when you're asking for money or you're giving money. Don't be robotic. Like, if you're going to message me on LinkedIn or you're going to send me an email, make it personal. Don't copy and paste from what you sent to Bob down the street. Like, at least you don't have to research my firm or our company or know what we do, but don't just say, hey, we're looking for money. Here's this, here's this. Like, say why you think it's a good company. Let me know that you looked at my LinkedIn profile and you know what maybe you don't know our thesis, but you know that we spend money in your area.
Hello, everyone, and welcome to this new episode of the Fundraising Insiders podcast, the podcast where we put what is behind the check and we put it inside the deck. Today, as per usual, we have an exceptional guest, of course, but an atypical guest. I keep repeating this literally every episode, it feels like, but when I speak about fundraising, the number one thing that comes to mind is either an angel investor, if you're very early stage, or your traditional VC that comes from Silicon Valley and invests in AI. Guess what? We've got something different again today. And I think that's what makes the whole depth of this podcast is the variety of investors we have. And today we dabble into family office. I'm really excited to talk about it. Hunter, we've been having a couple of conversations here and there, a lot of email threads. We've already done warm introductions to different people left and right. But today we're going to go into depth of where you come from, because I think that the story is actually quite an interesting and again, atypical one, and to what you're doing today and all of those different arms and those different hats you wear. It feels like it's a recurring thing with guests on the show that people wear so many hats, and you might be the one that wear the most hats. So let's see if you can take the hats trophy. And without further ado, Hunter, welcome to the show. Please tell us who you are, where you come from, and what do you do?
Yeah, happy to. Thanks for having me on. We've had a lot of conversations. I'm really excited to talk through a bunch of topics today. Yeah, I'm Hunter. My background is, atypical is probably the best word for it. It's not super interesting, but it's very different and weird. I didn't go to business school or any college. I am not one that likes institutional learning. So I graduated a year early from high school. Never wanted to go back to school after that. Got straight into business. Well, I'll say business. There was some trades work in there, which you thought was pretty funny. I leave my carpenter role on my LinkedIn as a remembrance signal for me of what started all of this. My good friend started a carpentry company two or 3 years before I started with him. But I just got out of college, or just out of high school. I had just finished as a heavy machinery mechanic. Didn't want to do that anymore. Got into carpentry, then needed some stability, which carpentry, just like all entrepreneurship, if you're in a trade, entrepreneurship, it's not very stable. So started looking for other stuff. One thing that's not on my resume that I keep off because it was so short was my dad is a pilot for American Airlines. He started that when I was 16, 17. So he was a few years in. So whenever I was ready to be done being a carpenter, he said, hey, if you want to go to pilot school, and become a pilot for American, you should go do it. Like, we'll help out. And I was like, well, I don't know. Me and my wife had just started dating, and I was like, I really think I want to marry this girl. So let me go see if I like the schedule. And the easiest thing you can do to get into the airlines is go be a flight attendant. So I was a flight attendant for, I think, 5 months just to see if I liked the schedule, and ended up hating it, and proposed to my wife while I was in training, and then decided this, schedule of 5 days completely gone horrible.
Flight attendants only date flight attendants, and it's kind of same for pilots. I actually used to be with a girl that got into Qatar Airways, and she's now in a very happy relationship, very happy for her, with a guy that is also in a flight attendant, and it's like all they talk about is planes. And I'm not about that life, and the whole schedule, as you say, is just crazy.
It's working in airlines is best if you're single, or if you're past the life stage where you have young kids at home or want to start a family. That's really where it works really well. Or you're married, with another flight attendant or a pilot. Yeah, so I jumped out of that. My dad, before that, was a diesel mechanic for 20 years. So I know a lot about cars and a lot about the automotive industry. So whenever I was ready to be done doing that, I walked into the dealership that he worked at for 12 years or something like that. That's the one he retired at, left at, and said, hey, I just need any job that you'll give me. I need to get out of the aviation industry. So I was a driver delivering parts. And then I think in 6 months, I was on the counter selling parts, to customers. And then 6 months after that, I was there for 2.5 years total, I think two or 2.5 years, and was basically over all of our wholesale department. So all the shops in the area that needed something, I was the one that they called and dealt with. I ordered the parts that we needed, all that stuff. So I ended up managing kind of that pipeline. And I feel like I had reached, this may be an ADHD thing or it's just an entrepreneur thing. I feel like I had reached a cap at a typical corporate job where there wasn't a lot more headroom for me there. The guy above me had been there for 20 years and he was going to be there for the next 20 until he retired. He was not leaving. So I just reached kind of my headroom there, started looking for other stuff. And then a staffing conglomerate reached out to me, got pulled into that, did that for a little while. And then my boss's boss's boss at the staffing agency called me and said, "Hey, I'm leaving to go do this thing. I think you should come do it with me." I was like, "Well, what's the thing?" And he sent me this data room. I didn't really know what a data room was at the time. This was 4 years ago. Yeah, right at 4 years ago.
Yeah.
And so he sent me this data room.
2023 is when I see the whole West Wind chapter starting from.
Yeah.
Have your LinkedIn.
Yeah, it was crazy. There was some fun stuff before that I did before I joined, but yeah, he called me and said, "Hey, go lead this data room. Let me know what you think about it." I called him back with a litany of questions, and he said, "Good questions. Come to Bartlesville, Oklahoma," which anybody that's listening that knows anything about Oklahoma, Bartlesville is this really, really small, nothing town, and it's almost Kansas, Oklahoma. It's very, very small, but it's very overdeveloped because it's where Conoco started.
Oh.
So it's, well, Phillips. I think it's where I don't know, remember the history, but it's very overdeveloped. It's like its own little New York. It's an incredible town. So I went up there. He gave me, a couple days to kind of look at everything, meet everybody, and say it. And then he said, "Hey, I want you to come and raise money for this thing." And I said, "I don't even know what raising money means. What are you talking about?" So then he hired me on. We moved to Oklahoma shortly after that, me and my wife and one kid at the time. Now we have 3, and started raising money. 6 months in, I was leading all the fundraising. And then for the 3-year lifespan, I was raising all the money. I think we did right at $100 million whenever I stepped away of accredited investors, 100 to 500K at a time. No big checks, no VC, no private equity coming in and helping us out. It was all small checks. But me and him ran and raised a ton of money. Got that company whenever we joined. I think he was the 5th employee and I was the 6th employee. So it was a very small, tight-knit team of people that started that company.
Before we run into the next one, because I feel like this is where you're heading, I just have a question. Is you said there's no VC, no institutional cash, only small checks amounting to 100 million. Cap table must have been a nightmare. Like, how you deal with a board with so many investors? Like, let's get into like maybe some of the early learnings of the business era of Hunter. Is like, how do you manage all these people? How do you manage all that cash coming from so many different sources?
A lot. It was stressful for a while until you kind of learn a system. We used to use it as a flag that we were very proud of not anybody else really does fundraising like that. You don't see typical companies that are going out and raising, $100 million and doing it $100,000, $500,000 at a time. So yeah, it was pretty intense. It was a lot to manage. We had to build some internal systems on, newsletters and things like that and getting in touch with people. But there came a certain point where we had to grow the team because there was so much inbound happening from current investors and forward-looking investors that we had to bring somebody in that was managing, these people have these questions. Yeah. Investor relations was really big, which I tried to manage for as long as I could, but it just got so intense because, we ended up with, it's not an incredible amount of investors because a ton of people doubled up. I think it was just over 200 investors that did it. It was 200 investors got us to
You say it's just a little over 200. When sometimes you hear VCs that will say, "Oh, there's more than 10 people on the cap table, we're not in." Like 200 sounds
we had people tell us
crazy.
That. Yeah, so it was a really big cap stack to raise in total. We did a small portion of it at accredited and then went to, the big private equity and the big banks. Goldman ended up running a portion of it, and there was some of the big private equity groups that I can't name that were kind of looking at coming in and taking a swing at $100 million, $200 million in equity. But yeah, it was intense, and we didn't ever realize that it was great for us, but it was also bad for us because we didn't realize that it was such a problem until the first VC got on and said, "The first thing that I would ever give you money for would be to clean up this cap table and get everybody out."
Gotcha. Okay.
And we realized okay, this is a ton of people. And then all the PE groups that we ended up, ultimately working with, or, they're still working with, ended up being okay with it. But looking back now, what I probably would have done is put together some vehicle
Yeah.
that
An
would host
SPV
all of
or
them,
something.
and it'd just be one investor on the cap table, which we were all young and just running full force, so we didn't think about that. But yeah, anybody
So
that's listening, I would recommend something like that because it makes, I mean, obviously your communications is still chaotic, like you still have to figure all that out. But cap table wise, it looks like you have one big investor or maybe three investors that came in for a good portion.
right. So learning number one of the podcasts: have a clean cap table earlier rather than later.
Yeah.
And just quick question there: when did you manage to clean the cap table? What was the way that it was cleaned? Was it buying out some of those smaller investors, or how do you go about cleaning that cap table then?
There was no cleaning. I don't know what they've done now.
Okay.
I don't think they have because everybody had such good preferential rights on
Mm,
equity that it'd be pretty hard to buy them out. It'd be a really big vote to buy all of those guys out, even from a private equity group. So
gotcha.
yeah, mostly the private equity groups were basically just looking at coming in and joining. We also did something really interesting that most startups don't do is we pre-diluted ourselves. So the founding team had 40% rather than having 100% and selling down as you
Mm-hmm.
raise and
Mm-hmm.
diluting yourself and
Mm-hmm.
everybody else. We put everything in escrow and took 40%. It was basically the founder, the main founder, and then everybody else was in this 40%, we'll call it. And then the rest was saved for, Series A, Series B, whatever we needed to do. So it was a lot easier on that side to kind of manage the cap table outside of the chaos of everything,
So
having everything else.
it's why you were happy to dilute overall. Okay, so it's
Yeah.
very starting from the end kind of reasoning where you need to know how many rounds you're gonna do because otherwise. Okay, interesting. Okay, what were the key? What were the benefits of doing that, and what kind of situations would you advise maybe founders to do that in?
I think it probably how much you're going to raise. I mean, if you're only going to do one round, I don't think you have to worry about it. But we knew it was
Mhm.
going to take steps in series to get it done, so we wanted to make sure we had a bunch of buffer on the back end to safely do it. But also, when a VC came in, they knew that we were happy here and we weren't going to try to die on a hill of no, the founder has to maintain 80% equity in this company. Like we're
Gotcha.
happy
Okay,
here. We have this much that we're willing and able to give. If it goes over this, then we'll have to dilute, which we don't really want to do. But
gotcha.
I think
Okay,
that, yeah, as a founder, you just have to figure out how big is your cap raise and do you need to break it up, which I advise a lot of people to do. There's been several companies that I've kind of talked to, and they were going to go do $100 million round, and it was going to get them all the way here. But right now they had nothing. And I said, well, what if you went and did a $10 or $15 million round right now? How far would that get you? How
yeah.
much more proof of concept would that get you? And they were like, well, that would get us here. And I said, okay, well, you should probably go and do that.
Mhm.
So in those things, I don't think you need to pre-dilute, but if you're going to do 4 or 5 rounds and you got a lot of money to raise because you have a lot to prove and do and raise your valuation, I think bringing yourself down and then setting everybody else up is pretty good because it just
Gotcha. It sets
it
boundaries
avoids
as well.
dilution. Hmm.
Okay. So now we get to the interesting bit because we get to what is your today activity
Yeah.
when you left Westwind Elements after this first steps. I was gonna say dabbling, but dabbling for 3 years and raising 100 million is more than a dabble. When you started with YW Holdings and the activity more recently with Dragonfly Family Office, let's talk about this part of the career.
Yeah, yeah. So I'll start with YW Holdings because it had crossover with my past. About a year in at Westwind, I realized that I was, good at what I was doing and I'd made, good steps at going forward financially. Wanted to start placing that in good places. Friends and family started, trusting what I was doing and knew what I was doing, that I was good at it. And then, other investors that I had met, they're like, hey, I've got extra capital. Where should I put it? So I created YW Holdings as a vehicle for that. So it's my personal holdings, but it's also where I syndicate through. So I've done
Mhm.
some multifamily syndications, I've done some oil and gas syndications. I've done quite a bit, but that's the holding company that, lives and breathes in just a very diverse amount of industries that I find fun, that I'll go and ask friends, family, or other investors that I know, like, hey, do you want to jump into this deal? I'm going to go do it. So that's YW Holdings. That kind of got me really, I think YW Holdings and that idea in my brain is what led to really actually meeting the family office and getting into this world, because I had a couple deals going on. I wanted a place to kind of find some more organic investors rather than beat all my current friends up. So one of my investor or almost investors is on the Capital Commercial team, which is one of our portfolio companies. And he introduced me to another one of our portfolio companies called LPShares, because it's a marketplace for GPs and LPs to post and get out of their positions or sell new positions. And so I got on a call with the founder of that, and he said, "Oh yeah, post your multifamily project on here." So ended up meeting him and figuring all that out. Ended up closing that deal. And then I guess it was probably 6 months later, I was ready to step away from the current startup because we were moving back down to Texas to be close. We were about to have our third kid. We wanted to be closer to family. So I was like, it's time for us to step away. And it had gotten very, very corporate, which is a good thing. It was growing. It was 5 employees when we started, and it was 93, I think, when I left. So it had gotten very corporate and grown a lot. And I wanted to get back to diversity, which YW Holdings was helping me with because I've been able to do stuff in the background, but wanted to get into it kind of full time. So I stepped away with not really a plan, nowhere to go. I was like, we're just going to take time off till the baby gets here. And Paul, the founder of LPShares, which is the secondaries marketplace, heard that I had left, and he called me and said, "Hey, you should meet our patriarch, and you should come down to Austin and, get to know everybody and say hi." So we did a call first. He asked the most intricate details about my life that I've ever been asked in my life, which if anybody ever meets Doug, you'll completely understand that's just who he is. He's going to pound you for details more than you should give him. So then I ended up going down to Austin and meeting them in person. And then one of the portfolio companies that we're looking to acquire, he actually brought in while I was there for me to do due diligence on and poke holes in and see if we wanted to do it and all these things. And then after that meeting, he said, "Hey, would you run that company if we took it on and, come join the family? And, we've got a bunch of buckets you can help in. We've got commercial real estate, which we're the largest individual owner of commercial office space in Texas. We've got this secondaries marketplace that I think you can help in. We've got this and this and this and all of these buckets." And my eyes just lit up because the idea of having a ton of diversity in a lot of different places to run was pretty exciting for me.
That's what you were kind of waiting for in the first time. Yeah. Okay. So We've got it. YW is a vehicle setup holding, basically, for different investment deals. With YW, are you only looking into early stage deals, startup deals, or are you also looking into real estate and stuff like this?
Yeah, pretty much everything. YW Holdings and the family office world have kind of merged. So family office is everything official that we'll do, but still I'll do syndications and personal stuff through YW Holdings, because if we have a really good real estate deal going on in the family office, because we do a lot of real estate, if we have a really good real estate deal that's got a 15% cash on cash, which is a deal we just did, I'll go and call on my friends and my investors and say, "Hey, I'm going to jump into this. Do you want to join?" And then we'll funnel it through YW Holdings, probably do a little syndicate with us, and then go jump into the vehicle. Gotcha. So yeah, it's not very picky. I'm a really VC focused guy. I love startup world. I love ingenuity and entrepreneurship. I'm not ever really going to be the guy, I don't think, that just goes and puts a ton of money in a fund or 15 funds and doesn't do direct investments.
We're going to get to that point. It's because the family office perspective, which is somewhat new to the show here, is the diversification of assets. I have never seen a family office that does purely direct investment in startups in the early stage. Otherwise, it's called a VC. And it's also because, the only way I would see this happening is if the patriarch or whoever starts the family office at this point is a retired VC or a retired entrepreneur that knows the game and only works in that game. But usually in the family office, tell me if I'm wrong, but due to the lack of talent and expertise, you spread out into diverse asset classes and you allocate money in different pots of money. One of the pots is direct investment into startups. And a second pot, which I think would be also very interesting to talk about today, is investing directly in funds. So can you tell us maybe a little bit more about how you play those two different strategies between direct investments and investing in funds, which is something that is a bit more recent? I believe we've had a few email threads and exchanges on this topic. How do you juggle between the two? How do you I don't know, create the allocation, say 5% there, 10% there, X% in real estate, X% there, etc. How do you develop that strategy specifically for the fund of fund versus direct investments?
I think it comes down to where you consider yourself an expert. Not that you're necessarily an expert, but where is your knowledge base? My knowledge base is more on doing due diligence on VC type companies, on startup world, on things like that, especially in a few sectors. So that's where I know I'm confident in, but it also, you can't put all your money in that bucket. So where I'm going with that is, if you're an expert in VC, you're probably going to put more money in that bucket than funds. Our fund bucket is where I'm not an expert. Like healthcare, we do a lot of healthcare investing, but we're not experts in healthcare by any means. But there's a
Gotcha.
couple really good companies, a stem cell clinic, and xenotherapy, and a whole bunch of stuff that we invested in a fund because they're the experts. I mean, there's a
Right.
guy on there that has 500 publications. I mean, they're incredible at the space. We really like this space and we know it's going to do very well, but we're not experts in healthcare, but we want to invest there.
So you delegate by going through the
So,
intermediary. Gotcha.
yep. So we put it in a fund. Whereas, if I see, let's call a nuclear startup, there's one that is looking at posting on LPShares and some other things. Like that one, I'm not an expert in nuclear, but I'm an expert in industrial startups. So I know how to at least look at that company and
Right.
see if it's got traction, if it's got legs, if it's a good deal, and we can assess it and know if we're going to direct invest. So I think that's the difference, is where you're an expert. But I think the other part is, how big is your team of experts? Because if it was just me deciding where all the buckets were, I would get over exhausted on being an operator of these companies. Not that you're necessarily operating each one of them, but direct investment is a lot more hands-on in most
Of
scenarios.
course.
Whereas a fund, you can delegate and you can just get rid of it. You put your money and you don't ever think about it again, typically. So I think that's probably a part of it, where you have to think not only where am I an expert, but also where is my time more valuable? Like, should I just put, $1 million or $10 million in this bucket of funds because it makes more sense for my time to go focus on the other things that the family has going on? Or do I have enough time right now to go put $10 million in this startup that I think is going to do really well, but I'm going to have to monitor it and work on it a little bit?
In terms of the thesis, usually my kind of discussions with funds are fairly easy. They have a thesis because that's how they raised from, family offices or any other sort of LPs. And it tends to be very straightforward. Can you say you have a thesis per se? And if yes, what is it? Is there a specific type of ticket you prefer putting? Do you have a geographical thesis? Do you have a sector thesis? Do you have a stage preference or something like this? How do you assess someone sending you a pre-seed deal versus a Series B deal?
I'm pretty agnostic on, I would say we're stage agnostic or series agnostic. I learned from being in startup world, you get told no from a lot of people that would have been very valuable and good investors just because of series, which I get. Some people have very strict theses and I'm not knocking them, but I always wanted to be kind of the open-ended guy. Like, you can send me whatever deal you have and I will look at it and tell you yes or no on whether we're capable or we want to do it. That's what I always wanted to be going forward. So we have a pretty open thesis. I mean, obviously commercial real estate's a lot of our portfolio. I think our portfolio right now is, depending on valuation, I think it's between 3.8 and 4.2 billion or so. So commercial real estate is heavy for us. So we focus a lot more of our time on commercial real estate. We're looking to wind that down and then focus in other areas. I would say really our focuses are between secondaries, which you and I have talked a lot about, and secondaries, healthcare, and probably industrial is going to be kind of the three. So commercial, secondaries, funds, and industrial and healthcare is probably our kind of four main, what we're really kind of going after. Especially as we start to get more out of real estate, we'll start getting allocations bigger in those buckets and start running in those.
And when you're talking about secondaries, a secondary is just is a type of asset. It's not really a sector itself. The secondaries would follow the same kind of sectors. So it would be secondaries of industrial, of healthcare, etc. Gotcha. Okay. I also think we had a little bit of a conversation on sustainability, which was one of the new things you were kind of looking into. Can you tell us about the angle you'd like to tackle on sustainability, what it means, what it represents to you, family that is behind Dragonfly?
Yeah, I think sustainability is an interesting conversation because it's such a big category.
Yeah, I know.
I like the sustainability that investors are not just investing on because it says ESG on the tag. I don't ever want to just put money in a bucket because it's going to be good publicity or something like that. I want to actually invest in something that's changing something or making something better, like the nickel refinery. It's an industrial manufacturing plant, but it's very sustainable. One, because it fully recycles all of its materials. And two, it's bringing refining over from where China owns majority of it to the States, to where then we can sell to everybody, but we can also buy from mines all over the world and give them a better source outside of just China forcing pricing down and forcing into slave mining. So companies like that are really interesting to me, where it's actually sustainable. They're doing something that has impact, but it's not your typical sustainability company that you would typically think about.
Gotcha.
And there's a lot of examples of things like that. But I like that space more than I like just investing because it says sustainable on it. I like something that has impact, has sustainability, but is still in a very specific sector or industry where it's not just this big tag of ESG or sustainability.
We've talked about many different things, and I think you really highlighted the wearing different hats kind of thing. And when I asked you, hey, can you send me maybe a couple of your pain points that you have in your current activity? The number one you said was how to manage all of those different things at the same time, because they work with what you call different capital clocks. So money moves at different pace in, say, real estate than it does into a direct investment, that it does into a fund, etc. Let's dive a little bit into this thing. How do you run different clocks at the same time without ever getting capital jet lagged, if you allow me the expression?
Yeah. It's a hard thing to manage until you get into the flow of how it works. So I'm big about blocking your calendar. And how that works out. So, this half of this day I'm working on this, and the second half I'm working on this. But that only goes so far, because like for me right now, all the ones I sent you are stuff that we're directly operating. These aren't funds that we put money in or things like that. It's our real estate portfolio, our real estate company. It's our secondaries marketplace. It's this new startup that we're about to jump into. And then it's, managing everything else that we're already in. So it's not like we're just putting money somewhere and then I'm having to manage that. These are direct operational roles that I'm helping with or overseeing, or directly having to dive in and put fires out or solve problems and be a part of the actual business. So you can't just time block your way to salvation on that, for lack of better terms, because all of it's going to run into each other. This clock is, Monday is really, really heavy in real estate, but also there's, 72 things going on in the secondaries marketplace that we have to deal with. So I think having a good team, one, is the most important part. Like, I have the guy who runs the secondaries marketplace. Me and him work a lot together, because there's some times where I have to just be like, hey, I can't work on this. Can you cover and do it? And he has his team help him and stand up and do it. And then the same on commercial real estate. There's a lot smarter people than me in that company, and I'm just jumping in to try to, we've got a mezzanine need here. We've got an equity need over here. We're trying to work on this building. So there's a big team that's helping do all of those things, that I can just go in and say, hey, I really need this, or I need this information. I'm about to jump on this meeting to put this fire out. Can you help me out here? So I think that's a big part of it, but also just understanding that it's chaotic. I think a lot of people get into situations like this, especially on family office world, because typically you get into a family office as like your retirement job, because it's easy. You're just kind of directing people and telling things where to go. Understanding that there's going to be chaos and there's going to be a ton of things happening at once, that you just have to figure out what is the biggest priority at the moment and go from there.
Gotcha. Let's talk a bit more on the secondary marketplace. Is a thing that is not really common in Europe, because secondaries, or at least LPs trying to sell their shares or trying to recover maybe through secondaries some of their investment is a lot less common, and it's linked to probably the financial education in the US. That's the conversation we had in the episode that should be released tomorrow at the time we're doing this. The episode with Bruno, episode number 8. If you haven't seen it, go check it out. And he was saying, we were talking about the difference in risk aversion in Europe and in the rest of the world, and in the US, where in the US, kids from high school start to invest in stocks, and the financial understanding is a higher, meaning that people are willing to take a risk, start somewhere, fail, restart in another state, and it's perfectly fine. Where in Europe, there's that fear of failure because risk is less understood. There is less blended finance that happens, and funds tend to be very single stacked or single layer. It's a just VC or just PE or just this, just that. In a family office, you do a bit of everything. So let's talk about the secondary market in this case. Explain, of course, maybe do a very brief reminder of what is a secondary marketplace, How do you operate? Are you in touch directly with, I don't know, VCs selling their shares before the next round? Why are secondaries even happening? Because one might think, hey, if the company is going so well, why would you sell your shares now and not just stay in for the long run or wait for the IPO or the M&A or stuff like this? So tell us more. What are secondaries? What is the marketplace? What kind of the profiles that are in the marketplace? And then, of course, what do you do within this marketplace? What's your objective there?
Yeah, the secondaries is interesting because it's so broad. We're obviously pre-IPO secondaries are a really hot topic right now. We're dealing with a lot of those. This buyer wants X amount of SpaceX before it goes public, or this seller wants to sell at a 1.4 trillion valuation before the SpaceX IPO because he got in at a $400 billion valuation. So he can make a ton of money right now. So there's that section. And then there's why we started LPShares, which is a much smaller category. These are billion and $500 million transactions on pre-IPO stuff. And then there's the smaller side in which we started it. So Capital Commercial Investments, obviously a big real estate company. We have unhappy LPs like everybody has unhappy LPs. You get in a deal, it's a 5-year deal, but it takes another year to lease it fully up before we can fully sell it. So you have the guy that wants out, or, hey, this is taking a little too long. I need liquidity because I want to jump in this other deal. So that's really why we started LPShares as a secondaries marketplace, because we wanted to be able to go to that guy, let's call him John, and say, hey, John, understand you've gotten a little bit of cash off this deal already, but it's going to take a little bit longer for us to sell it and you get your big upside. So what if we found a buyer for you that would buy your, $1 million portion for 800 grand?
Yeah.
And you could just get out the deal and jump.
So it was a liquidity need. The liquidity was the problem, and the way to create that liquidity was the solution. And that was your solution to it. Gotcha. You mentioned this into the commercial real estate. Is it something that you've also expanded to VCs? Because, of course, we're talking startups is the ecosystem within which this podcast exists. And secondaries happen also in the VC space, where maybe a fund has a certain lifetime and they need to show the returns to their LPs before a certain amount of time. Is that something you've already dabbled in? Is that something you're trying to dabble in?
Yeah, so there's a lot of that on there currently. It's a lot of real estate. There's some oil and gas deals on there. There's some just random direct investment in companies in random sectors. There's one PE fund. They just went on there. Their LPs are willing to sell at a very significant discount because they just converted from an income fund to a growth fund. And here's an interesting thing about the marketplace, which is a good VC conversation as well, is these PE groups, their equity multiple is a 5x in 5 years, right? That's what they're planning on doing at the base level. If you come in and buy that for 50% discount, well, then you technically have a 10x in 5 years. So it's a way for you to get really significant upside on what you're putting in, because you're buying $1 million worth of that fund, but you're buying it for 500 grand.
Yeah.
So there's a lot of upside in buying like that. And just the same thing in VC. We've got 2 VCs that are about to launch on there, and they're doing the same thing. One of them has a guy inside the fund that wants out because he needs liquidity for X reason. And then the other one is just a VC that wants some of their own portion taken away because they have a lifespan that they have to get to, and they just launched another fund and they're going to go do that thing. So there's a lot of those pieces. We had a conversation 2 weeks ago with a very tech-focused VC in the seed stage area, and they have gotten very lucky with a ton of unicorns and been very, very blessed by doing well in that area. But one of their companies is doing well, but they need to put this $5 million block that an investor put into another company. So they're bringing that $5 million to us and saying, hey, can we put it on the marketplace, and could it trade for, let's say, $4 million? So a little bit of a discount, and we could put that money in the other grouping.
So from what I hear, it's still very LP-GP interactions. I'm not hearing a lot of, for example, a fund that wants to divest early, or just to divest some of the shares they have in a specific company. We're talking about the whole fund here.
Yeah, there's direct in companies, but I wouldn't say it's really on the VC level yet where they have a direct investment and they're wanting to pull out of that position. I wouldn't say that there's a ton of that, other than one guy that's about to post a position. He is a VC and they're selling a portion of a stake in something that they put money in. I think it's like a $3 million position that they're going to get rid of.
And do you see this being something that grows in the future? Is it something that you personally want to grow, or are you seeing this just being limited by the sheer nature of it?
No, I think it will grow. One of the other pain points is educating people or trying to sell people on something that they don't know they have yet, or a
Yeah.
problem they don't know they have yet. And the secondaries marketplace is very similar. This option for liquidity has never really been a big thing until there's a few marketplaces like us that offer liquidity to LPs or GPs or funds or VCs now, but it's never really been a big thing. However, think about the future of what you can think as you can lower your risk profile as an investor. I think about this retail center we just did. It was let's call it a 15-year investment. And it was going to start
Right.
producing cash in the third year. And it was producing good cash in the third year. But this guy was 10 years in and he's 80 now and he's doing estate planning and he needs out. And he sold to us for a good discount. We got in. Now we're getting a 16 cash on cash, basically. Imagine instead of looking at everything as, okay, this is a 10-year investment. I have to put risk capital up for 10 years. What if the marketplace didn't have to think like that? And they could say, I really only have to put my risk capital up for X amount of years. It's a 10-year fund or a 7-year fund, but I only really need my capital in there. If it's not proving itself or doing something by year 3 or 4, I can rinse and repeat that money because I can go sell it to somebody else that has the capability to wait another 4 years and sit in that and take my 4 years I already put in and then just wait another 4. So I think it just changes this whole risk dynamic of the investment marketplace, which I think will just grow and get bigger. I don't think there's any way that the secondaries marketplace goes down. I think it will just trend up.
Is definitely something that is, as you say, trend is the right word. When we talk to investors, it's something that is being pushed towards, but requires, as I said, a bit more financial maturity to understand those kind of markets. So the more platforms like that, the more people can look into them and try to establish new strategies. LPs are starting to be furious that the 2020 money or 2021 money from the COVID era, post-COVID era, where, interest rates were really low, they put cash a bit everywhere, and now we're reaching the 5 years of investment. We need to divest, and yet nothing's coming out. So there is a need for liquidity, and introducing this market might add that flexibility that VCs were so much looking for, and LPs, of course, just above that. So thanks for talking about that. We talked about setting people on the problem that they don't even know they have. Let's briefly finish with your third pain point before we move to the next part of the podcast, where you were talking about credibility is the currency and you cannot print it. And I feel like here we're touching something very human. It's the credibility aspect, everything running on trust. You said it yourself in your own career. Everything happened on the basis of, I know a guy who knows a guy, or the boss of a friend. It's all very human. So when you have such a broad network of people you have to be in touch with, of businesses you have to run, of capital clocks you have to be aware of, how do you build that trust? How do you keep the trust? So we're going to talk about keeping the track record and your whole, I think you have this trick you were explaining to me where every now and then you just open your phone and you go through the directory letter by letter. But what are the kind of strategies that you would advise to people, either founders because they have a big network, or also investors who are managing a deal flow, for example, to keep up with all of this? What are your tips and tricks about gaining that credibility and then keeping it?
I think the number one answer is communication. If you can just communicate, even if what you're communicating is bad news, just communicating. And I think especially founders who are raising, you have to get out of this ideology of every single person I have to talk to has to add value monetarily to what I'm doing right now. Sometimes it's just about picking up the phone and calling somebody, communicating with, the guy that is not going to put money in, but because you called him and you cared about, his daughter broke his leg 3 weeks ago and you're calling to check on her and say, hey, how are you doing? How's your daughter? That guy may then add credibility to your name because he knows that you don't think of him as just a ticket of money. You think of him as a human being, and then he'll probably refer you somebody. So I think it's just this whole game of communication and not just disposing of people once they've given you money. That was one of the big things we did. I had repeat investors over and over again that had invested with me. And then they doubled and tripled and quadrupled down because I stayed in communication with them. Every 90 days, I would give them a call and say, hey, how are you? Hope we're doing good, blah, 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 and just chit chat with them. And then 2, when you're doing that and you're staying in touch with them and they know, and 2 months after you got their investment, you call them and say, hey, how are you? Just wanted to check in, not asking them for money or anything like that, but you're just connecting with them on a human level. That's whenever you start getting this referral network and program of they want to introduce you to their friends because you're one of the very few investors or investments that called them. and checked on them and stayed in the loop.
Mhm.
It's very rare once people put money in to talk to the founder or talk to the, CIO or the CDO or
Right.
anything like that ever again. So I try to change that dynamic of I'm going to speak to everybody frequently because I don't want you just for your money. I want you because you're a valuable person to have in my network.
Gotcha.
One, you're a good friend. I got really lucky with most of my investors are good Christian guys, which I am. So we connect on a spiritual basis as well,
I see.
but also too on a lifestyle basis and all of these things. So just trying to stay in the loop with them, understand who they are, them understand who I am, and then this network of, hey, I've got extra money, where should I put it? Or, hey, I've got this friend who may like this deal,
Mhm.
or, hey, I'm starting this company. Do you have any advice for me? And then you just start this repeated process of good connection. Now, it gets intense because you have a lot of people calling and talking to you then,
Of course.
but it's just another piece to manage that you have to
So
figure out how to do that communication.
that's that. We have the theory, we have the what to do. Now let's go to the tools. Do you just pick up your phone and that's it? Do you have an Excel spreadsheet? Do you use Notion or Airtable or any kind of CRM? Or do you have any tools that send you reminders every 90 days? Do you do that automatically? Do you put specific tags on different profiles in the CRM? There's so many ways of doing that. What was the way that you're
Yeah.
doing it?
So when I was directly raising money, I had a CRM with all of our investors in it,
Mhm.
and I would just call through it and I would just go down the list of like, hey, I'm going to spend 2 hours today calling our investors and talking to them. And I would get from A to C, and then I would just keep going down the list. Now that I'm not really raising money, what I like to do is just call people when I'm in the car. I'm in the car, I go to Dallas. It's an hour drive for me to Dallas because I live out in the country, and then it's an hour drive back. So I can spend that time calling people. Or when I go
Gotcha.
to Austin, it's a 2.5 hour drive. So I have 2.5 hours. And in no specific order other than alphabetic, or if I have somebody I need to call, or, there's sometimes where I do it like this, where I'll say, okay, this stealth startup that we're doing right now has for growth, or we need more connections, or we need, I need to get some industry advice. And I'll say, okay, it's in oil and gas. I'm going to call my oil and gas friends and just chit chat with them, ask them for advice, ask them how their kids are doing, talk about what we're doing and seeing if they can offer any advice or anything like that.
Right.
So sometimes it's by industry on what I'm needing at the moment, advice for, or to just vent about or talk about. And then other times it's just, I'm in the car for 2 hours. So I'm going to call everybody in my phone that starts with a D and just chit chat with them and say, hey, I haven't talked to you in a year and a half. How are you?
So the key word seems to be never have like empty time. If you have
Yeah.
time, use it to communicate. That should be your go-to is if you have a bit of free time, what do? You pick up your phone and you call someone. And whatever happens out of it, it's more than if you had done nothing. Right.
Yeah, totally
Beautiful.
correct. That's one thing I learned from our patriarch in the first week of meeting him.
You said, yeah, he's
I
always on the phone. Always, always.
always on the phone. And it's such an incredible thing that seems so dumb and so simple, but it's such a the relationships and the progress in business that I've had just because I spend time on the phone with people and talk, not even about business most of the time, but it gets around to it. It is incredible. But he literally, if he's in the car for 5 minutes, people will say, oh, I haven't talked to this person in a little while. Let me call him, see how, whatever's doing or how their business is
Gotcha.
doing. And he'll just call him. And there is never a stale moment in the car. And we're in the car together and he'll say, hey, I've got my friend Hunter here in the car. He's doing X, Y, and Z with me. Just wanted you guys to meet. And then I'll sit there and chit chat with these guys. So it's also just this network handoff of this mutual, I trust you, you trust me. Here's some of my network. Here's some of my friends. Here's their life and things like that.
And so let me ask you maybe let's do like a case study. I'm a fund manager or even a company founder. How do I implement this? And how do I do that with you, for example? I want to get investment from you guys. Should I directly call you and tell you about that? Or should I try to call you about something else and then slowly move into the business aspect? Is there a way that you bring business you feel that makes it better than how others do? Like, do you think you have a specific way of bringing in the business topic when you're in a conversation? Oh, by the way, I have this deal right here. Or do you just start with that?
I think it's best to start with it. There's this thing, especially around family offices, that they're very guarded and you have to have a relationship to get in. I vow to change that because I don't enjoy that.
Okay.
I don't think you should have to have a relationship to then start business. I think you can start business and then curate a relationship because that's what I did for 4 years straight. I
Right.
started in business, said, hey, I've got this really cool thing that you should be a part of. Here's what we're doing. And then I curated a relationship out of that. So there's this big ideology that you have to, you're not getting into a family office without having a relationship tie. I'll tell you, it's not going to go for everybody, but just email me. I put my email in my bio on LinkedIn for this reason right here. Like,
I saw.
send me your deal. Send me your name and what you're doing and what you have going on, and I'll look at it. It's probably going to be a quick no most of the time because you get blown up with bad deals. But I think you just have to be open to that. And I think if you're a fund or a VC and you want to implement like communication, pick the person on your team that you know can handle communication and is who you want representing your firm. That is
Gotcha.
one really big thing. Like, you don't want to put the guy that's really good at sales, maybe, but his personality doesn't line up with your, ideology, or maybe the
The
view you want
ethics,
of your
the
fund
vibe.
being out in the world, the ethics. Yeah.
Gotcha.
It's better to find somebody that, one, is good on the phone, that can communicate, that will carry those relationships for a long time, and not just try to keep getting money or keep doing this thing. You don't want somebody on the phone that's going to say, hey, you invested $1 million with us last year. I hope you're doing well, blah, 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 blah. And have 10 minutes of casual conversation. And then the whole point of the conversation was, we want more money from you.
Yeah. Okay. There's a sweet spot of business, but not too much business, and the intent
Yeah.
behind it. I'm being conscious of both your and my time. And we've done a lot about family office, and maybe even more the Dragonfly vision, or your vision of family office, which is very specific because you said that there are some things that are common to most family office, but you're trying to disrupt. So those very interesting talk. And I think we can move to our flagship format, which is the this or that and yes or no. We still haven't changed the name of this format because it's very straightforward and it works, but it's not very complicated. I'm going to ask you questions. Option A, option B. You reply with either or. You can say both or you can say none. There's no specific hard rules. I am no one to judge. I am only here to collect the answers and later on to help having a reflection on this. So if you're ready with it, let's go. So
Let's do it.
all right, what matters more for you, relationships or returns?
Relationship.
Secondaries or direct investments?
Direct investments, typically converting over to secondaries.
Do you prefer leading or co-investing?
Typically, we're a lead.
Deck first or call first?
Deck first in most situations.
Gotcha. Is it something that happens because of the way the industry is, or is it the way that you do things?
I don't mind a call first at all, but I just prefer a deck to know if we're even somewhat aligned, or if it's,
Okay.
I'm totally fine having a relationship with you, but I would like to tell you no on your investment in a very quick 2 seconds if I can read it and say that it's not a fit for us.
To avoid wasting time.
Yeah.
Gotcha. What matters more to you, the founder's story or the market size?
Founder's capabilities plus story.
Gotcha. Impact or financial returns?
Probably blended. Yeah. I like
Okay.
impact a lot, but you got to have good returns.
Of course. Check in manually or automate the outreach?
Check in manually all the way.
Warm introduction or cold emails?
Got to have both. Can't do one or the other.
Build it or buy it?
If you can afford the time, build it.
Early exit or go long?
Go long. I'm a generational guy.
Operator or investor? As in, that's what you do, or is that's what you would prefer to be?
That's what I prefer in most circumstances. I like to operate as little as possible and invest in a lot.
Gotcha. When someone has either a vehicle from YW Holdings or directly from Dragonfly Family Office, what is the actual product you offer? The network or the capital?
Both, typically. And if we invest, we're going to bring along co-investors. Like the healthcare fund we just did, we did a good portion of it, and then we reserved a spot for our co-investors to come in.
Gotcha. Okay, so that was the questions. We can take a deep breath. And I'd like to go to one of these. So the operator and investor. It's funny because you start your career as an operator. You are very much an operator at heart. And you were brought in the family office as an operator. Yet you said investor. And I'm actually surprised. I thought you were going to say operator at heart, turn investor, or something like this.
Yeah.
And yet you were very much set on the investor and operating as little as possible. How come?
I think it's a time thing. Operate as little as I can is probably not the best way to put it. I think selective operation and limiting that where you can is best. Like,
Right.
I want to operate in the segments that I know I can operate and be a value add and do good. I don't want to operate in all the other sections. I don't want to be the investor or the guy that's coming in and buying a business and saying, I'm going to operate this because I can do better than you if I can. So most of the time, investor, because I like the thesis, I like the founders, I'm going to invest in it, but I'm not capable or have the time to operate it. But for the things that I do have time to operate, Like there are two of our portfolio companies that I am deeply ingrained in operations because I know I add value.
Would you say that being a good investor is what allows you to be a good operator, or the other way around?
Yeah, I think so because it saves you time. One, you don't have to worry about financials as much, but also
Gotcha.
two, you can afford to give your time to the things that are in build mode rather than in, harvest mode.
I see. And then we had a question about early exit or go long. It's funny because we're talking about different capital clocks. So sometimes you need an early exit, sometimes you need to go long. Your preference
Yeah.
goes to going in the long run and being that generational investor or builder in that sense. What do you mean by go long? Can it be just 7 to 10 years? Or are you talking even more than this? And how are you combining this with the activity of being an investor sometimes in the early stage or in startups where the cycles need to be shorter?
Yeah, I think you've got to find the mix and the balance that you can afford, but that you also want. Like we're very cash flow heavy. We do a lot of assets and a lot of companies that are cash flow heavy where we're getting active returns.
Mhm.
Those ones are great to hold long. But,
Right.
the ones where you're, like I'll speak in real estate terms, like we buy a building at 0% occupancy. We lease it, we buy it for 100 million and we take 4 years to lease it, do some renovations, whatever we're going to do to it, and then we
Right.
sell it for 400. Like you got to have those deals so you then can do the long-term holds. Like one of the portfolio companies that we're building right now is probably in the next 7 to 8 years, $1 billion revenue producing company annually.
Gotcha.
But it's also going to produce cash. There's 2 people on the cap table right now. There will probably end up having to be a third to really get where we need to be, but we're
Right.
going to bootstrap most of it. But because it's such a clean cap table, such a good cap table, and it's such a good revenue producing company, why would I ever sell that or get rid of it or do anything with it? I would rather
I see what you mean.
hold that for as long as possible because it's going to spit off such good returns and it's a good company. So I think you have to find this balance of you can't be all long-term hold because you'll die, you'll starve yourself out. But you can't be all short-term hold because then you're just having to do so much more manpower every day of churning these deals and getting in and getting out and getting in and getting out.
I see what you mean. Gotcha. Okay. I think that was it for the this or that format. Unless I think you were very, very sharp on answering either one or the other. There weren't many both or it depends, etc. So I think we're ready to go on the other one, which is the yes and no. And yeah, if you're ready, we'll go with that.
Full send.
So let's go. Do you think most founders have any idea how a family office actually makes decisions?
No.
Do you think that prevents them from even trying to approach family offices?
Yes.
Have you ever passed on a deal and then watched it succeed?
Yeah.
Do you think the secondaries market is a sign of the venture market being in trouble?
No.
Is it possible to maintain deep relationships at scale without losing what makes them so valuable?
Yeah.
Do you think sustainability first founders make harder pitches than growth first founders? As in, it makes it harder to evaluate when sustainability comes before the returns.
Yeah.
Have you ever changed your mind on a deal after saying no at first?
Yeah.
In today's market, do you think that impact investing is mostly marketing?
Yeah.
Do you see that more as in being an LP trying to go in the impact fund or as a direct investor going into an impact company?
I think most of the funds that are doing it is marketing. I think there's a lot of good direct companies that are actually impact companies.
Are you more nervous or excited about where AI is going for capital markets?
I'd say excited. Yeah, I have a weird view on it.
Would you have gotten to where you are today without someone taking an early bet on you?
No.
Do you think fundraising is fair?
Yes.
And finally, are you having a good time on the show?
Yeah, having a blast.
Beautiful. That was the quickest yes. And that's my personal win. So there were 2 very long yeses. Let's start with the second one, which was, is fundraising fair? And I know it's only 3 words and it's often where we have a lot of discussions. You said yes. It wasn't a very convincing nor convinced yes, if I'm correct. Explain yourself. You have 4 hours.
I think it just you have to frame it the right way because most people think that fundraising is just like sales and they're just going to come in and, beat the phones and beat the emails and they're going to get in front of people and then they're going to convince that person that they have a good deal.
So like a numbers game.
But it's just so different than that. It's partly a numbers game, but if you see it as a numbers game, you're going to see it as unfair because your conversion ratio is going to be 0.25%, whereas in normal sales, call it 20%. So you can't see it like that because everybody has a thesis, everybody has a thing that they do and a thing that they don't do. So if you're just sending out emails and phone calls to everybody under the sun that you think has money, it's going to be unfair. But
Gotcha.
if you're particular and you're doing your research and, put it in Claude, you don't have to do the research personally and waste time, but find the funds, the VCs, the PEs, the accredited investor pools, the geographic regions that typically invest in your type of thing, and you reach out to them, it's going to play much more fair because you're talking to people that are actually capable and willing to do what you're wanting. But if it's just a numbers game and you're just trying to hire a sales team to go and call people and convince them to give you money, yeah, it's going to seem unfair all day long because that's not how the business runs.
So it's fair if you play fair, if you make it fair for yourself.
If you play the game correctly in the way it should be played, I think it's fair, yeah.
Gotcha. And the other one was, is it possible to maintain deep relationships at scale without losing what makes them so valuable? Which is where we run into I like this episode because we talk a lot about time and time and the unelasticity or unplasticity of it. When you have a 2-hour drive and you're in your car, there's only so many calls you can do. And in 24 hours and with only one head and 2 ears and one phone, or sometimes you can have as many phones as you want. At some point, you only have one mouth and 2 ears. Yeah. So this is where it's incompressible. So scale and time, how do you juggle between both? And do you think that today that it's a barrier for you? And are you trying to break that barrier, or are you comfortable with the way this barrier is today?
Yeah, I'm at an inflection point, and you may even call this a pain point, because it is an interesting spot that you have to pivot at some point. If I get to a point where I can't manage 1,000 people, 2,000 people on my contact list of rotating and calling them frequently, I have to at some point pick, okay, here's the people I can handle. Here's a 100-person list or a 200-person list. And these are the people, one, that are going to scale with me, that are worth having in my corner, that are really good friends. Not that I'm going to ignore the rest of the contact list or the rest of the connections, but these are the people I'm going to pour time into because I know that it's valuable for me to pour time into.
Right.
One, they're a really good spiritual connection, or two, they're a really good business connection, or we cross benefit in our relationship. I think it's, back to your comment on time, it's an evaluation of who is worth pouring into continuously rather than at some point you have to go from shooting a shotgun in the air and you got birdshot in it. It's going all over the place and you hope that it's landing somewhere. That's how I treat it, how I have for the last few years. I'm just shooting a shotgun, calling everybody. At some point, you have to do more of a, let's call it a sniper approach of, let me constrain my view and my target of, here's where I want to go, here's how I want to grow, here's how they want to grow. Okay, this person matches up with me. This person matches up with me. And you got to kind of do it like that. And there's obviously going to be outliers where you're calling everybody, but yeah, I don't think you could scale those relationships unless you defined what it looked like to move forward in those relationships. And then figure out who fits in the right bucket.
So the hard work is to select who is in the birdshot spread versus who gets some double out buck in a way.
Yep.
Gotcha.
Yeah.
All right. I think we've covered pretty much everything I wanted to cover. And now we go to the last portion of the show where it's a bit more freestyle, a bit more personal. Is there any topic that you wish we could have discussed? Something you want to tackle, or a specific learning that you would have for maybe the yourself of the past, or maybe things you'd like to see in the VCs you're trying to approach, or in the companies you're trying to approach? Any specific advice, wisdom words, or any specific topic you want to debate, just you and I, and see how it goes.
I think you and I agree on most things. You made a face whenever I said, do I think impact investing is mostly a marketing gimmick? And then I said funds and not direct companies.
True. There was this one as well.
Your output.
It's true. It is. So it's actually a very funny thing because it's the kind of thing that everyone says, but if you listen to everyone, it feels like everyone's calling bullshit apart from them. And you're like, not everyone can be doing the BS and it's only you doing the good thing because that's what everyone is saying. Yeah. And it does feel like in funds, there is somewhat of a battle to who's the most legitimate to be a climate investor. And I'd say it's something fairly new because if you go in a fund that does, you were talking about industry, for example, you take the fund, you look at the GPs or the principals or whoever is in there. And if they've done a 30-year career in an industry, you see they know the industry. Sustainability being a bit more recent, however, it's harder to look at who's really legitimate to do sustainability. Everyone can be legitimate to do sustainability for all I know. And there are all those things where in Europe you can be an Article 9 fund, Article 9, Article 8 fund. That means that you have certain commitments in reporting and impact and all that stuff. And you don't know whether it's just a matter of, hey, look, I've ticked all the boxes that makes me legitimate, hence I'm legitimate, or I'm legitimate, but I still have to do all the boxes. And just adding a new box to justify whether you're legitimate or not doesn't, the fact that you tick a box doesn't reflect whether you tick the box for the purpose of ticking the box, or you tick the box because it's part of, what you have to do. It doesn't reflect the intent. And it's true that companies, I feel like there was a wave of companies that pretended they were sustainable because it was a hot topic, or founders who got into a sustainable product because it was the hot thing. And I've heard so many times, like in my own time as a founder, so many times I heard, oh, you're doing stuff in sustainability. There's tons of money out there for you. Okay, sure. Like, where is it? And maybe it was just the end of that timeline where people were throwing money at sustainability. But now that impact has grown borderline too big of a hindrance, of a burden, there's a harsh slap back to reality to, okay, it needs to be a good business. That happens to have an impact. Like the nickel refinery you were mentioning earlier, it's a great business and it happens to do things in the way that is sustainable. And I don't know whether funds are ready to hear this, or whether they're ready to, or if they're rightly equipped to find this, or if maybe they're even scared of being called out, in a way. So I don't know. I know I've sent you a bunch of funds that are sustainability funds that are looking for funding. And I said, hey, look, they're all here. Let me know which one you want to have the warm introduction to. And I'll be more than happy to do that. But how do you know which one's true and who's not? I myself, for knowing those partners, sometimes the funds, sometimes associates, whatever, or people that invest in my own company, I sometimes don't even know who's doing what. And if you listen to who's, the what we call the corridor words, or corridor noise in French, which is the whispers of what founders are saying, it brings a bit more information, but there's always a veil of opacity between founders and funders. And I suppose, and you're going to tell me all about it, also between the LPs and the GPs, it kind of feels the same, that hierarchy or that path of funding between who's giving the money to who's receiving the money. I'd like to have your opinion on this. How are you sensing this? How have you analyzed this in your career of investing in other people who manage funds?
Yeah, I think your opinion's spot on. I want to talk on that for a second. You have to find the people that just had the box ticked and then are doing the thing, not ticking the box so they can have the branding and then going and doing it. That's kind of my opinion, because I've run into people that do that, of like, okay, well, we can get into this new investor pool if we have this. So let's go get that, put it on the one pager, and then we'll get more investors because we can get into this other marketing pool. But to go back to your question, I think what I've found to be the most important thing, and this may just be because it's me and I've worked at some of these places and seen these things, is there's typically two guys on what we'll call your fundraising team. You have the guy who's going to only tell you about the mission and the sunshine and rainbows of the company and all the beauty and why it's perfect and why you should, of course, do it. And then you have the guy that knows all those things, is going to tell you about them, but he's also very forthcoming about all of the adversity, the trials, the things that they've run into, the lawsuits, this and the that, and isn't trying to cover those up with the sunshine and rainbows. What you don't want is overexcited investor giving you money and then realizing that there's adversity that they have to overcome, because that's when you get an unhappy LP. So I always like to do business with people like me, because this is why I think I had so much success, was telling the truth constantly, giving all of the facts, not just the pretty ones, and basically doing a reverse sale on somebody, saying like, hey, there's risk in this thing. There's these hurdles we have to overcome. There's these problems in the industry, but here's why we think we're the ones fit to solve it. And I like to go find those people to do business with.
Have you ever faced a situation where you were called maybe too pessimistic for being what you believe is only just realistic? Because I know that's something that I encounter. I know my co-founder was the more diplomatic, talking about the whole vision and stuff. And I'd come in and say, well, yeah, but look, the material's not done. We still need to do X, Y, Z. And I've been called out for saying that. And I was thinking, no, it has to be said. But how do you juggle with that balance? And have you ever felt like you were too much on one side than the other?
I don't think so, because I think you find the balance naturally of being optimistic in all things other than the things that are negative facts, is what I always try to say. Is like, when you're talking sunshine and rainbows, really be excited about the sunshine and rainbows. But then when you're talking about the negative facts, display them with, I don't know the best word for it, but display them with not excitement, but not negativity either. Like,
Gotcha.
if I'm telling you about a lawsuit that we're in, we're not in a lawsuit. I'm just giving this as an example. If I'm telling you about a lawsuit that we're in, I'm not going to say that it's the death of the company and like it's horrible and like it's a risk that we can't overcome. I'm going to tell you what it is. I'm going to tell you what we're doing to overcome it and why we think we're going to get out of it. Like, there's this thing about, don't be negative about the negative things. Like, speak to them as facts, not as emotion. I think is probably the best way. Like, be factual, not emotional. If you're emotional, you've lost the game.
I see what you mean. Now, let's finish up with, again, a bit of a scenario, a bit of a role play. I'm a VC or a founder, whatever, and I'm trying to approach you. What are the things that really make me stand out as an investment opportunity? Of course, the money is part of it. The returns, the financials need to be sound. That's one thing. Other than that, what are the key things that you're looking into, either a GP, if we're talking about investing into a VC, or in a founder?
One, non-robotic communication. So just talking about direct communication to me. I love that AI can do so much in our lives and be incredible. But when you're in our industries, when you're asking for money or you're giving money, don't be robotic. Like, if you're going to message me on LinkedIn or you're going to send me an email, make it personal. Don't copy and paste from what you sent to Bob down the street. Like, at least you don't have to research my firm or our company or know what we do, but don't just say, hey, we're looking for money. Here's this, here's this. Like, say why you think it's a good company. Let me know that you looked at my LinkedIn profile and you know what maybe you don't know our thesis, but you know that we spend money in your area.
Gotcha.
Something personal like that is good. And just lead with the request. I love relationship and I want to connect with all people. And just because I don't like your deal, if you send it to me, does not mean that we're not going to stay connected. But don't bury the lead. Like, if our first interaction is you saying, hey, I've got this deal that needs funding, or hey, can you give me advice in this area? I'm going to respond to you. I'm not going to not respond to you because you're asking me for something. But don't bury the lead and make it seem like you just want to be friends and, we've got all these synergies and things like this. And then you say, well, I've got this company, and you sneak it into the conversation. Just come forthcoming with what you want. And I'm either going to tell you no or yes, that we'll look at it. And then two, even if it's a no, if you're cool or we have valuable friendship going forward, or maybe it's a no right now, we're still going to stay in touch. But if you bury the lead, I'm probably not going to stay connected with you because that is frustrating.
Could be that it's a no for you, but it could be a yes for one of your mates, or vice versa. Yeah, fully understand. I think that's it. I think I'm running out of questions, which I think is a good thing. Yeah, maybe very last few words on, is there a topic that really keeps you up at night at the moment, or maybe an industry where you'd really like to invest some money in right now and you're looking for that champion, and maybe someone listening to this podcast or someone listening to that podcast knows someone who is a champion in that field? What would those fields be? Anything that you're really keen on investing right now?
I think next level industrial is really interesting to me. We've had a lot of calls with some SMR, some small nuclear guys. I like that space because I'm very bullish on, I think, electrification. I think the goals that we put on society and to push and do all this thing is never going to happen, but I think we are going to electrify slowly. I think we're going there, and I'm totally happy with that. But I think what will eventually change that is going to be nuclear. Once we figure out how to really do nuclear on a small case, I think most things are going to convert to that. So I love that space.
Gotcha.
One, I really love it, but I also know a ton of the VC groups that are investing in that space right now. They're friends of ours. So I like that space. Yeah, I would say that's really the one that I enjoy. Not nuclear specifically, but just kind of like this next level. The founders that are trying to build something in industrial that hasn't really been done before, or maybe it's misunderstood and it's going to do something different. I like those kinds of things. I don't know that I really have anything that keeps me up at night right now, other than our commercial real estate portfolio. We've got some stuff we've got to do there. We're looking to sell some of our buildings. We've got some data centers going into some of our buildings because we have a good portfolio for that, which is fun. We've got some mezzanine needs, which I've talked to you about, or some new senior lien positions, either way. that those may keep me up at night, I would say.
There's a
But
company supporting in their fundraise. I don't know if it really enters the future of industry kind of type, but there's like tens of thousands of brick kilns in Asia that are very ancient technology, and they just use a ton of coal, and they create a lot of fine particles, which create a lot of respiratory disease. And they found a they're reviving an old technology that is now being made efficient to use. I think it's 43% less coal and 90% less of those fine particles, and they're trying to spread to develop that first in Southeast Asia and just in Asia in general. I think they have a big contract with Nepal and the first pilot running. And the brick industry is massive. I think it I don't want to say anything stupid, but it generates a huge amount of carbon emissions and fine particles. Is that the kind of thing that, new materials, novel manufacturing could be something you're interested in?
Yeah, that's interesting. Yeah, I may rephrase what I said. It doesn't have to be something brand new. I'm actually not a big R&D guy. I like not reinventing the wheel, but making the wheel better. So things like
Gotcha.
that, where it's like, hey, we have
Making
this
the wheel
problem.
better.
There's a better way to do it. And we made that problem.
We-
Or we made that wheel.
Hunter, thank you so much for sharing some of your wisdom, some of your experience, what you're looking into, and genuinely opening a new door to this podcast with the whole family office perspective, which is very, very interesting. And we'll be in touch for sure over the phone. And I don't know if you have any last words.
Nope, that sounds perfect. I had a good time today. Hopefully it adds value to somebody that's listening, and glad we met and we're staying connected. I think it's going to be a good relationship.
Beautiful. Thank you so much to our auditors. If you're listening to this on Spotify, you want to see our beautiful faces, as always, you can head on YouTube. If you want to share some of the learnings of this podcast, we will be cutting small clips and shorts with the key highlights. And by the time this podcast comes out, I hope that I'm done working on the repository, which is a website where we will have all of the key highlights, the key learnings, very easily accessible. So if you want to learn anything about how a family office works, or on, I don't know what else, big topic we talked about, how to create warm introductions and to maintain your network, those are things that you will be able to find there in a very easy way with the timestamps to come back to the episode, etc., etc. So check it out if you have any specific questions to see with all of our guests in the past. And for everyone else, we will hear you in the next one. Hunter, thank you so much again.